All right, today we are cracking the code on trading charts. So if you've ever looked at one and just felt totally overwhelmed by all the different patterns and squiggly lines, this one's for you. We're going to cut through all that noise and get right to what actually matters, what's really telling you the story of the market. Let's get into it. And get this, our source material kicks off with this pretty bold claim. The trader behind this says they've tested pretty much everything and found that almost all of these classic patterns are basically useless. It's this flood of information, right? It's exactly why so many of us get burned out on technical analysis. And that's the million-dollar question, isn't it? If most of this stuff is just noise, where's the actual signal? Well, that's exactly what we're here to figure out. We are going to filter all of that down to the very few patterns that our source says actually work. But first things first. Before we can start reading the advanced stuff, we have to learn the alphabet. And in the world of charts, the alphabet is the single candlestick. You got to understand what one candle is telling you before you can understand what a group of them means. So you might be thinking, why not just use a simple line chart? Well, the difference is night and day. A line chart just gives you one piece of data, the closing price. It's like skipping to the last sentence of a chapter. But a candlestick, it gives you 4 crucial data points for that same period. The open, the high, the low, and the close. It tells you the whole story. So let's break it down. Think of a single candlestick as a snapshot of a battle. Whether that candle represents 1 minute, 1 hour, or 1 day, its shape tells you everything about the fight between the buyers and the sellers during that time. Who is in control? How strong was their push? It's all there. The colors are the first, most obvious clue. Green, or sometimes white, means the price ended up higher than where it started. Simple. Buyers won that round. Red or black means the price closed lower than it opened. The sellers were in control and pushed it down. Easy enough, right? But the real story is in the shape. That thick part is called the body. A big, long body, that's pure momentum. A tiny little body means nobody's really sure, total indecision. And those thin lines, the wicks, they show the extremes. A long wick at the bottom tells you sellers tried to slam the price down, but nope, buyers fought back hard and pushed it right back up. That's a story of buying pressure. All right, so we've got the alphabet down. Now let's start forming some words. We're about to dive into the 6 specific patterns that our source says are the most reliable signals you can find. First up, the engulfing pattern, and the name really says it all. You see how that second candle's body just completely swallows the one before it? This is a huge power shift. In a bullish engulfing, it shows the sellers were in control, and then the buyers just came in with overwhelming force, totally erasing the previous move. It signals a potential big-time reversal. Next, we have the pin bar, and this one is all about rejection. That long, pointy wick tells such a dramatic story. On a bullish pin bar, you can just picture the sellers trying to push the price down, 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 and then they hit a brick wall of buyers who just violently shove it all the way back up. It's a massive signal that one side's push failed spectacularly. Now, not every pattern signals a reversal. The 3-bar continuation is about, well, continuation. It tells you the current trend is still going strong. Think of that small candle in the middle as the market just catching its breath. You get a strong move, a little pause, and then whoosh, the trend kicks back into gear. It's a sign of a healthy, strong trend. The 3-bar reversal, on the other hand, tells a totally different story. Here, you see momentum building for 2 candles in one direction. And then the 3rd candle comes roaring in and completely wipes out all the progress from the previous 2. This is a sign of a sudden, total collapse in momentum and a powerful shift in control. Okay, breakout candles. I love these. They're like a coiled spring finally snapping. You see the price just moving sideways, wound up tight with these little, indecisive candles. Buyers and sellers are in a standoff. Then, bam! One single huge candle explodes out of that range. The stalemate is over, and one side just won a massive victory. And finally, number 6, shrinking candles. This pattern is just a beautiful visual story of a trend running out of gas. You can literally see the momentum dying as each candle gets smaller and smaller and smaller. It's a huge warning sign. Then, when that big candle appears in the opposite direction, it's basically confirming that the old trend is exhausted and a new one is likely beginning. So now we have our 6 powerful patterns. Awesome. But here's the thing. And honestly, this is the most important part of this entire explainer. Just spotting these patterns randomly on a chart isn't the strategy. To make this work, you need context. I want you to burn this into your brain. Yes, the patterns are powerful signals, but their power increases tenfold when they show up at the right location on the chart. Seriously, where a pattern forms is often way more important than the pattern itself. So here is the actual strategy, broken down into 4 simple steps. 1. Get off the noisy, low time frame charts. Stick to the 1-hour chart or higher. 2. Identify your battlefield, a key level of support or resistance. 3. Be patient. Let the price come to your level. Don't chase it. And 4. Watch for one of our 6 high-probability patterns to show up right at that key level. That's your signal. Let's make this crystal clear with an example. So imagine the price is in a downtrend. It's falling. But you've already marked a key support level on your chart, a line in the sand where buyers have shown up in the past. Now, you just sit back and watch as the price gets closer and closer to your zone. And then, boom, right as the price touches down on that support level, what do we see? A perfect, textbook, bullish 3-bar reversal. Now, this isn't just some random pattern floating in the middle of nowhere. It's a specific, powerful signal appearing at a critical location we identified ahead of time. You see how that works? The key level told us where to look. The candlestick pattern told us when to act. It's that 1-2 punch, the combination of location and the signal, that gives us a really high probability setup. It confirms that buyers are in fact stepping up to defend this level, and a bounce is very likely. Okay, let's wrap this all up. What we've really learned here today isn't just a list of 6 patterns to memorize. It's a completely new way to look at a chart, a way to actually see the story the market is telling you, one candle at a time. And if you only remember 3 things from all of this, please make it these 3. Number 1, stop wasting your energy on the 99% of patterns that are just noise. Focus on the few that actually matter. 2, stop seeing candles as just red and green rectangles. Start reading them as a story, a battle between buyers and sellers. And 3, the big one, context is king. A great pattern at a meaningless location is useless. A great pattern at a key level, that's everything. So the next time you open up a chart, I want you to try this. Don't just see lines and colors. See the story. See the battles. See the wins and losses. See the momentum shifting. Charts are telling you a story every single day. The only question is, are you ready to finally start reading it?